When banks lend money, they know some people will eventually default. Let us look at how they account for these potential losses. The provision for credit losses is an expense account on a bank's income statement that captures anticipated future loan losses. Banks use models to set aside capital for loans they expect will go bad, even if the default has not happened yet. This practice helps ensure the bank has enough capital to absorb shocks, keeping the institution stable even during economic downturns. A provision is a prediction of future trouble, while a write-off is the final step taken when a loan is truly uncollectible. When the economy faces uncertainty, banks typically increase their provisions to ensure they are prepared for rising default rates. It is a vital part of financial reporting that keeps banks honest about the risks they are taking on their balance sheets. Understanding these accounting terms helps you see the bigger picture of how banks manage risk. Thanks for watching and stay curious.